Welcome to Trademark Capital Management's review of the October 2025 FOMC meeting. My name is Peter Mothy, and I'll be your presenter today. Let's get right into the notes. No surprise to anybody, lowered interest rates by 0.25% to 3 3/4 to 4%. This was not unexpected by anybody. However, Chairman Powell went on to say another cut in December should not be seen as a certainty. That was somewhat of a surprise to the markets. He also stated that quantitative tightening to end on December the 1st, the Fed will allow MBS, mortgage-backed securities, to roll off of their balance sheet, but the proceeds will be reinvested in T-bills. Now, what this simply means is that there will be some added strain on the mortgage market since the Fed will not be reinvesting and buying mortgages in the open market, but will instead be buying Treasury bills to shorten the maturities of the overall Fed portfolio. This month's decision was not a unanimous decision, much the same as in last month's meeting. Also, note there are only 4 more meetings with Chairman Powell as the chairman of the committee. Now, the rationale behind this month's decision was inflation remains elevated at about 2.8%, but it is estimated to be only around 2.2% after the effect of tariffs are taken into consideration. This is much closer to the Fed's target, so they're focusing more on labor than they are on inflation. They noted that labor demand is slack and labor participation is softening. They also pointed out that the economy is growing modestly, but not in all sectors. Also noted by the Fed was that the shutdown impact on the economy is expected to be only temporary. Now, onto the yield curve. You can see after yesterday's rate cut, the short-term interest rates controlled by the Fed continue to lower, which is on the left-hand side of our screen here. The light blue line is the current yield curve going out to 30 years. The black line is 1 year ago. Please note that the Fed has lowered short-term interest rates substantially, but long-term interest rates have actually edged up a bit. This is partly due to the fact that the yield curve that we had a year ago was inverted. As you can see, short-term rates were higher than long-term rates, and a normal yield curve indicating a healthy economy is such that long-term interest rates are 1.5% to 2% above Fed funds. So indeed, if the neutral rate for Fed funds is down around 3%, which is down here actually off the chart on the left-hand side, that long-term rates are right about where they should be. So we should not expect much movement at the long end of the yield curve from here. In fact, we can see the 5-year and 10-year yields actually move up from here, even though the Fed continues to lower short-term rates. What this means, and this is significant, is car loans, which tend to be tied to the 5-year Treasury, should not be expected to go down very much, nor mortgages should be expected to go down very much, even though the Fed continues to lower rates. Now, what does this mean for investors? A decline in interest rates for money market funds and savings rates over the next 12 months, because the Fed, even if they don't lower rates in December, is expected to further lower rates in 2026. The economy should be expected to continue a slow growth path with the risk of future negative surprises on the growth front. No or slightly lower bond and auto mortgage rates, as I just highlighted on the yield curve. Also, a tightening of lending standards due to the slowing economy, driving increasing loan and credit card delinquencies, which we are already seeing, as well as bankruptcies. We're seeing a large move higher in the number of bankruptcies. If you have any suggestions for future videos such as this, please send them our way, and we'll try to get a video out, short but to the point, on your request. Thank you for joining us today.